Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club. And I want to talk to you about a couple of things today. One is the state of the market, and one is a way to take advantage of the state of the market. As we all know, the market took a big drop because of the coronavirus, bottomed out on March 23rd, and then we saw this historic rebound as I speak. The S&P 500 is up 28% from the low, which has astonished just about everybody. And they're all saying the same thing. How in the world can the economy be shut down and 26 million plus people out of work and commerce at a screeching halt? So no retail sales, no growth in sales or earnings, and the stock market is going up. Well, the answer to that, of course, is that the stock market is a leading indicator. Investors are always looking ahead. And they're also taking note of a couple of important things. And one of those things is it seems as if the mortality rate for the coronavirus, COVID-19, is turning out to be a lot less than what they thought. It was looking to be 3 to 5% when it came out of China and South Korea, and then it was down to about 1%, and now they're talking about a tiny fraction of 1%, which at 0.1%, which is some estimates, some of the most optimistic estimates, that's 1 in 1,000 people. And so maybe the coronavirus is not as deadly as was originally anticipated, which means it will be safe to reopen the economy sooner, because we're not going to overwhelm our healthcare facilities with sick people. And that's what's good for the economy, is good for retail sales, is good for corporate earnings. And what's good for corporate earnings drives the stock market higher. But I still think it's a time for extreme selectivity when it comes to investing in the stock market. I would not be a buyer of an S&P 500 index fund right now, because there's some industries that are set to do very well and some that are set to do very poorly. The energy sector, for instance, with oil selling for far less than what it costs to extract it, it's not the best of times in the oil patch. And it won't be until a lot of this production is cleared out, which means a lot of the smaller, highly leveraged companies will go out of business, that the big, more prosperous companies will be able to make money again. So it's a difficult time for oil and gas and for the travel industry and for brick and mortar retailers, and it's going to take them quite a while to come back. But there are other sectors that are doing really well. And some people say, well, what are those sectors? How do you know not just the sector, but the companies to buy? And one of the best known ways, of course, is to sort of hone in on what the insiders, the officers and directors that run a company, are buying for themselves. If they're buying millions of dollars or tens of millions of dollars of their own company shares with their own money, that's a pretty good heads up, because they have a huge unfair advantage that they own or they have access to all sorts of material, non-public information about the company's business prospects. They know what's happening with the employees and with the suppliers and with their competitors and with their customers in ways that we can't possibly know. And so I would much rather be buying shares of a company where the CEO and the president and the chief legal counsel are all buying shares themselves, versus companies where they're not, or where they're selling shares in mass. So I recently sat down with best-selling author Bill O'Reilly, and we talked about what insider buying is and why it's such a valuable indicator and which companies are experiencing heavy insider buying right now. And you can have access to that special presentation if you just follow the link in the description below. And I hope you do. So until then, I will see you next week.